In this video, we're going to talk about raising funds using common equity. And there are two ways that we can do this. You can do this by issuing new common stock. I refer to this as the direct method. And of course, the indirect method is by using retained earnings for the company. We refer to that frequently as internally generated capital. So if you you take the earnings per share of a company, what do they do with earnings per share? They can pay it out as dividends. Of course, as a shareholder then, you can do whatever you want to do with that cash. The logical thing is to reinvest it so that you can get a compound return on your money. Now, the remaining goes towards retained earnings. So retained earnings, in essence, is a reinvestment of your money. This is yours, and so this is your reinvestment of profits into the company. So it provides a sort of compound return when the company keeps some of your money and reinvests it. Now, when we get to talking in some videos later about financial structure and how companies make decisions on dividends, etc., this decision is very important. And as you'll see in this chapter, it's very important because the costs of financing, right, have varying levels of cost. They're not all the same level. So why do we need a cost for reinvested earnings? The simple, quick answer is it's an opportunity cost. Your money is reinvested, so that means you should have an opportunity to earn a return, at least what that earns. So again, this concept, we've talked about this many times, is really just an opportunity cost. You could take that and invest in anything. It's invested in the company, though. So if you received it in dividends instead of using it for retained earnings, that is the cost. That's the return that you would give up for that. So now we need to talk about the three ways to measure what they refer here as the cost of equity. R sub S here is the cost of retained earnings. R sub S is the cost of retained earnings. We have three methods we can use, and we've discussed two in previous videos. We could use the capital asset pricing model, which hopefully you recognize this as being the security market line formula. And you know we can look up this data. We'll talk about that here in a couple of minutes. We can use the discounted cash flow model, where we predict dividends a year out. That gives us then the value, divide that by the current stock price. This is dividend yield. Add that to the capital gains, or the growth rate of dividends. That will give us an estimate of the cost of equity. In addition, a new thing we can talk about is something called our own bond yield plus some judgmental risk premium. So we start with our yield to maturity, and then you add something, right? Where that something comes from, it's judgmental. Maybe you compare what the stock earns to what the bonds earn, right? So there's lots of ways you can kind of think about this. And we'll talk about it a little bit later, obviously, in the video. So the first method is the CAPM method. As you notice here, here's our spreadsheet. And down here are our boxes, or places where we can put information. The risk-free rate, beta, and the return on the market, 6, 1.25, and 11. So that tells us that the estimated cost of retained earnings using the security market line is 12.32%. So that's our first guess, if you will, at the cost of retained earnings. Now, there are issues with this capital asset pricing model. We've talked about some of them before. What numbers should you use for the risk-free rate of return? Most people say you should use the 10, 20-year number from the government bonds. There really isn't that much difference between 10, 20, and 30 years most of the time. 10 years and 30 years is usually published a little bit more frequently. So again, any long-term government bond is going to work well. What do you use for the risk premium if you need a risk premium? Well, if you kind of think about the averages, right? The long-term average risk-free rate, again, this is long-term average. Let's just say it's around 3.4%. The long-term average on stocks is around 11. I'm going to use 11.4 to make the math easy. So in reality, right now, it's around 8%. So if you use 3.5, it seems a little low to me. 6, 7, 8 sound like much more reasonable numbers for the current risk premium that we see. But again, what numbers you use is not really as relevant as being consistent with those numbers. In addition, you know that beta varies. Beta can change, although it changes slowly. But what's most important here is how beta is calculated. There are several variables that are important. Most important is, what is your definition of the stock market? Do you use the S&P 500, the Wilshire 5000? Do you use one of the Russell indexes? There are lots of indexes that you can use. Do you use 3, 4, or 5 years of data? Do you use daily or monthly data? So all of those variables will have an influence on the estimate of beta that you use. As long as you are consistent, then your decisions will be consistent with the data that you provide. Hopefully that makes some sense. So if you use your data, and you always use your data, your decisions will coincide with those costs. If you switch it around, now we have to worry about comparability between your different estimates. So if we look for the cost of equity now utilizing the discounted cash flow model, now we need D0, $3.26 is what we're told. Stock sells for $50, and we have estimated that the growth of dividends is around 5.8%. So that tells us, using the dividend model, the cost is around 12.7%. So now we have two numbers. We're going to use a third here in a second. But again, this gives us an idea, if you will, of how prices are going to vary a little bit. Sometimes the data just doesn't seem to work right, and the numbers will be bizarre. So again, just to make up numbers, if the security market line says it should be 12.3 and the dividend model says it should be 3.2, how can it be that wide, right? So something is wrong in the data that you're using that's creating this strange outcome. So sometimes you have to use a little judgment when you're doing some of this stuff, and kind of take things into your own hands so that it makes a little bit more sense. One thing we do want to talk a little bit about is how you come up with this growth rate. And we've talked about this in the stock valuation chapter or videos, and I just want to kind of review. There's a couple of ways we can do this. You can use the time value of money, right? In addition, you can go to the internet and you can use Value Line, Zacks, Yahoo Finance, and these are published numbers. Now, what number do you want to use? Well, here's the theory says that if the company does not change its payout pattern, that is, if they consistently pay out 60% of their earnings as dividends, if that does not change, and if their financing mix doesn't change, then if you estimate earnings, that translates also to estimating dividend growth. So earnings growth and dividend growth, under those circumstances, those numbers are going to be very close together. So again, if we look at estimated growth of earnings per share, that is also an estimate of the dividend growth rate. The third technique really coincides with our discussion about opportunity cost and retained earnings. So let's say a company is earning 15% on equity. So the return on equity of the company is 15%. It's been paying out 62% of its money as earnings, which means 38% is retained earnings. The money that's kept is earning this rate of return. So the idea is multiply what it earns by how much is kept, and that will give you a growth rate of those reinvested funds. So our formula, the growth rate equals 1 minus the payout rate, 0.46 in this case, or 0.38, excuse me, multiplied by 15%. This gives us a growth rate of around 5.7. Again, they used 5.8 in their example. So it's pretty close. Again, just to kind of repeat, you have to kind of look at the numbers and make sure that they really make sense. Reality can play games with some of these techniques. The third technique that we have is the technique that's the yield to maturity plus a risk premium. And again, just the point to keep in mind, this is a judgmental premium. So in this example, if I go down here to this next slide, 10.19 is the yield to maturity on this bond, and they are saying that they have roughly a 3.2% risk premium. So their required return, or the cost of retained earnings, is roughly 13.39%. So when we incorporate, again, that data down here, here's our three numbers. These three numbers represent the estimated costs of using retained earnings. If you find that average, the average rate of return for the cost of retained earnings is around 12.8%. The final cost that we need to determine is R sub E, where R sub E is the cost of new equity. The only thing that's new here is this concept of a flotation cost. So they're stating that they think the flotation cost is 15% of the price. So down here in our worksheet where you see flotation cost, they're asking for dollars. So you need to put a formula here, equals 15% times 50. That's $7.50. So now what we end up with is the cost of new equity is 13.92. So what we have now created, we have four costs. There are four sources of financing, and we have identified and calculated the cost of each one of those sources. We now have to figure, how do we use this information to determine the average? To determine the average, we need to know something about the weights. What is our financial structure like? So what are the percentages for each one of these sources that the company wants to use? Now, there's two things we're going to talk about here. The first thing is they have a target, right? They're going to try to hit some relationship that they feel comfortable with. In later videos, we'll talk about financial structure and some of the tools that managers might use to figure out what that relationship should be. But the first thing we have to identify is there is a target. There's something that they want to hit. And this shouldn't be totally unfamiliar. I think we do this as people, right? We say, look, I'd like to have 30% debt to my income. I don't want to borrow more than that. But when you go to the store, you have to make a choice at that moment. Do you want to use financing or do you want to use cash? And you make that decision at that point. So you have a target, but depending on circumstances, you may borrow a little bit more, borrow a little bit less. It depends on the circumstances. The second aspect that's important is we want to use market values rather than book values. And this is not, I guess, totally intuitive, but if you think about what we're talking about with this cost of financing, what is the cost of financing future dollars? So that means we're going to issue stock at their current market value, not at their book values. And the place where this would be most obvious, I think, is with common stock and preferred stock, because their book values don't change much over time, but their market values certainly do. So what we want to look at here, and we want to assume we know the company's target market proportions. What is that ratio? So how do we do that? We just have to look at the financial statements. This company has 3 million shares of stock selling at $50. They've got $150 million of stock, $25 million of preferred, $75 million in debt. So their total long-term capital structure is $250 million. So as we've done in previous videos, we just need to calculate the proportions. $150 million in equity divided by $250 million total means the proportion or the weight of equity is 0.6 or 60%. So it's 60% equity, 10% preferred stock, and 30% debt. Now in this spreadsheet, we just put those numbers right here as market values. And of course, here we have our weights. What this provides for us is a stepwise pattern. If you think about gathering money, the company starts with what I refer to here as the first tier. When you start gathering money, there's a cost. In this case, the cost is I'm just going to use 10.2%. Somewhere out here, though, the cost goes up. Well, why does the cost go up? Well, two of the variables have limits. We only have so much retained earnings, and if you borrow enough money, the banks get a little skittish, and they may lend you more money, but they want to charge you a higher interest rate. So the cost of sources go up. So at some point in time, the cost goes up because we run out of a cheap source of financing. And in this case, it goes to 10.6. Now, we're going to utilize this ultimately when we get to the capital structure videos. We're going to utilize this information to try to find good projects for the company to do. So that's the end of this video. I look forward to seeing you in the next one.